Hello, I'm Mark Dunne, AJ Bell's Head of Research, and welcome to Fundamentals, our regular look at the world of funds and collectives, where we highlight one of the most popular purchases on the AJ Bell Invest Centre platform, and then analyse why advisors and clients might be buying right now. This week, second on the list for passively run funds is X-trackers FTSE 100 Equal Weight ETF, or Exchange Traded Fund. An ETF is designed to track or mirror the performance of an underlying asset and deliver that performance minus any running costs. In this case, iShares X-trackers FTSE 100 Equal Weight uses physical or direct replication to provide performance. In other words, it owns the index's underlying constituents. This comes with an ongoing charge figure of 0.25% a year, and the ETF sells for just under £10 a unit as I sit here today. So far, so standard, but three things are particularly interesting about this ETF, especially as it is so far up the active dealing list on the AJ Bell Invest Centre platform. First, it's a very young product. The ETF only began trading on the London Stock Exchange last August. Second, it's still pretty small, with assets under management of barely £20 million at the end of the year. And finally, and this must be why such a young, small product has caught someone's interest, it is, as the name suggests, an equal weighted product. This means that each of the FTSE 100 members get the same 1% weighting in quite a different structure from the actual index, which is weighted according to market cap and available free float. So why would advisors and clients prefer an equal weight? By market cap, the FTSE 100's five biggest weightings are financials, consumer staples, consumer discretionary, oil and industrials, and that's the first chart. The next graphic shows the same sectors in X-trackers FTSE 100 Equal Weight, a very different picture. Under the equal weighting ETF, oil represents just 3% of assets, whereas financials, consumer discretionary, industrials, consumer staples and materials are the big five sectors, as per this chart here. In some ways, the ETF puts more emphasis on the domestic UK economy, with its higher ranking for financials and consumer and industrials and less on overseas events and commodities, something which some advisors and clients may like if they're looking to keep UK exposure but don't like the oil and mining stocks which are currently weighing on the sentiment. Note that the different weightings affect the valuation and the yield. As of the end of December, the ETF's underlying price-earnings ratio was around 19 and the yield was 3.2%, compared to figures in the low teens and nearer 4% for the actual market cap-weighted FTSE 100. The lower yield and higher multiple came from the lower oil and mining exposure, so this has to be borne in mind. Dividends, by the way, are reinvested after tax, as the ETF's mandate is to deliver positive total. Note also the ETF is rebalanced twice annually, in June and December, whereas the index charges quarterly, so there could be times when the X-trackers product could differ from the actual FTSE 100 by quite a bit. As a final point, the 0.25% ongoing charge figure is not high, especially relative to active funds, but is high for an ETF or a tracker, where single-digit OCFs are becoming the norm for vanilla FTSE 100 products. So you do pay a bit more for different structure. As this final chart shows, the FTSE 100 has lost momentum badly since last summer, and the miners and oils are largely responsible. It will therefore be interesting to see how X-trackers FTSE 100 Equal Weight ETFs perform fares relative to the index as it develops a fuller trading history. Thank you for watching, and I look forward to seeing you next time.